Hey there, thanks for tuning in. Welcome to Investing in Germany, and today let's dive into ETFs. So this is going to be a series of videos, so don't forget to come back and check the next videos and also subscribe. So I'm sure that this series of videos is going to really help you navigating yourself in the ETF ecosystem. So ETF is an exchange traded fund. As the name says, it is a fund that is traded in an exchange. So as a buyer of an ETF shares, I can go to a market and buy the shares from the exchange by exchanging my euros or dollars, and as a seller I can go to the market and exchange my ETFs for euros or dollars. So it's fairly simple, and there is no difference between buying an Amazon or Apple shares in an exchange or buying an ETF shares. It is the same process there. ETF generally they track an index, so there are thousands and thousands of indexes all around the world. It's very crazy nowadays. And the most popular index around the world is the S&P 500, which tracks the top 500 American companies. And then we have an international index called MSCI World Index, which tracks thousands of companies from different developed economies like Japan, United States of America, Germany, and so on. So there is a lot of index covering a lot of different industries around the world. So what is an index? So index is a method to track the performance of a group of assets in a standardized way. So it is a very standard. There is a set of rules and regulations for each index, which defines what comes into an index and what not. So for example, here I also have an DAX, which is a German index, which covers the top 40 companies of German economy. The most important part that you have to understand as an investor of ETF is that anybody can create an index. Even our friend Bob can create his own index here. For example, this index has 4 constituents, very concentrated portfolio, which are Siemens, Volkswagen, Adidas, BASF. And they are also having different weightages. So we have to be really careful while choosing an index to understand if it is something really a long-term investment or is it a short-term speculation investment indexes. The most challenging part of ETF is translating the theory into practical, because index is a list of asset groups which has to be tracked, and then you have ETF which has to go practically buy those asset classes and maintain this in a basket. So that is the complexity that we have here. So as you can see here, I have a chart of last 5 years between the X-Trackers ETF. The blue color is an ETF and DXF is a theoretical DAX. So as you can see that the ETF is nicely tracking the index behind it. There is some ups and downs, there is some differences between the two, but then over the long-term period it really follows the index. And this is really crazy because we have 40 different companies trading in the market, and each and every company going up and down based on some fundamentals or speculations, and the ETFs should really capture all the ups and downs of individual constituents of an index and make sure that the price of an ETF is really tracking the index as such. So let's get entered into how the ETF ecosystem works. We have 2 important characters within the ETF ecosystem. They are the authorized participants and the market makers. So authorized participants are mostly banks like JP Morgan, who have the right to create and redeem an ETF share. They are not obligated to create and redeem an ETF shares. Therefore, there are not just one authorized participant for an ETF. There will be more than 2 or 3 authorized participants here. So let's understand how the ETF ecosystem works with an example. So I, as a buyer, go to a exchange, buy 1000 ETF shares. So once I buy the 1000 ETF shares, I'm creating a demand, and therefore theoretically there should be an increase in the price because the demand is increasing. But then, as you know, the ETF should only track the index. It should not fluctuate based on the demand and supply. Therefore, what it happens is the market makers or the authorized participant, they provide the liquidity in the market so that there is an optimal level of demand and supply in the market. They push in 1000 shares of an ETF immediately into the exchange. Therefore, the demand and supply is always constant. For this, they have an inventory of all the shares. So the market makers and the authorized participants, they will have some inventory based on the trend, and then they keep pumping in this inventory into the exchanges in order to make the price stable and tracking the index. The market maker or the authorized participant, once they pump in the 1,000 shares into an exchange, they have less shares of an ETF. So therefore they go and buy an underlying security. So in the case of Bob, they buy the Siemens, BASF, Adidas and Volkswagen, and then they put it in a basket and give it to the ETF providers like Invesco, Xtrackers and so on and so forth. There are also thousands and thousands of ETF providers in the market. And then the ETF provider accepts the basket of securities, and then they issue the ETF shares, which then goes into their inventory. So what happens if somebody sells? So for example, if I go to the market and sell 1,000 shares, then it increases the supply. Therefore, the market makers or the authorized participant, they should immediately absorb this extra supply in the market so that the demand and supply is constant in the exchange. Therefore, the price of the ETF is tracking the index. So what happens if there is a lot of inventory, because they have now 1,000 more shares from me and they have a higher inventory? What they do is, the authorized participant, they redeem the ETF shares and then they get the underlying securities, which they can build a different portfolio based on other indexes, or they can just sell and cash it out. The market maker is a really important character within the ecosystem, because the market maker defines the price at which an ETF share should quote in an exchange, because the market maker is going to provide the liquidity or absorb the liquidity based on the underlying security. As you know, the ETF is made up of thousands of securities, so the market maker is having a close eye on all the underlying securities and defining the code which optimally tracks an index. Well, this is easier said than done, but there is a lot of algorithm, lot of computer power going behind the ETF in order to make the ETF to track the index in a closer way. This is really crazy system here. If you look at the amount of capital entering the ETF ecosystem worldwide, it's really crazy. At the moment in 2021, we have around almost $10 trillion invested in ETF worldwide. This shows the amount of craziness in the ETF and also how stable the ecosystem is. Even though it sounds like the complete ecosystem is really complicated in order to maintain the price level and following the index and so on, the ecosystem is really stable and also really trusted by the investors around the world. What you see here is the proud display of iShares universe of ETF, where they say that they have really vast variety of options in ETF for the investors who are coming into the market. But then does it even serve the purpose? Because one of the main argument to have an ETF is that it helps the normal average investor to enter into the market with less information or less knowledge. If you provide so many options, so many themes, so many different asset classes within the ETF, it is not possible that the normal investor will enter into the market and start investing without making mistakes. So from the investment point of view, one has to keep it really, really simple. No fancy, no crazy stuff. If it is going to be simple, then it is going to be a long-term wealth creation. If it is going to be complex, then it's going to be short-term speculation, because it is becoming really, really complex and nobody understands how to navigate in the ecosystem. So thanks for watching. I'll see you in the next video.